I taught real estate investors how to use this very specific type of life insurance that the biggest banks and corporations buy in the world. So most people don't realize that the biggest banks and corporations in the world are the biggest purchasers of life insurance. They even have their own name, which is called BOLI, bank-owned life insurance, or COLI, corporate-owned life insurance. And these accounts are not designed like the public buys them, or individuals buy life insurance. They're designed totally different. And then more importantly, they're utilized very differently. So I took this account that the smartest, biggest corporate or biggest financial institutions in the history of the world were using strategically, and I took that to the real estate finance market. And so I was teaching real estate investors and developers and builders and people with large real estate portfolios how to use this as a way to finance real estate. And that's an interesting conversation.
So these are people, and these are larger sums of money. This is pretty big. I'll say big money for a lack of a better term, but
Okay.
they're trying to. These are huge projects, like where you'd have to find other means of financing it by, I don't know, raising money or taking out loans, and then this was an alternative to doing that, or like in tandem?
It's not an alternative. It's a complementary or supplementary strategy to using the debt financing that banks provide, right? So normally a bank will loan you 70 to 80% loan to value. So round numbers, if you're trying to do like a commercial property for $10 million and put 7 or 8 different condos on it or whatever, they'll loan you 7 or 8 million of that 10 million, right? But then you have to come up with the equity, with the down payment, right? And normally for that, how people think of that is that they just take money from an account and they withdraw it from a checking account or savings account or money market account or whatever, and then they literally put that money in the property, right? And so what most real estate investors don't understand about that is that money is no longer earning interest. It's dead capital until you sell the property, right? So the alternative way to think about the strategy I teach is, instead of putting your own capital inside of the property, then what you can do is you can put it in an insurance policy or structure instead, and then ask the life insurance company to loan money against the money that you have in the insurance, your equity inside the insurance. And so think about what banks do, right? So banks don't never loan their own money, right? What do banks do? They loan the deposits, right? So banks will have people deposit money in their bank. They'll pay them 1 or 2% or maybe 2.5% in today's world, and it's taxable. And then they'll take that money and then they'll go loan money for cars or houses or credit cards, and they'll make a spread, right? And a spread is usually what we call yield in finance. It's a lot more than the average person understands. So for example, I pay you 2%, right? And then I go out and loan a car at 6%. Most people, their financial education will tell them that that's a 4% return, right? 2 to 6, right? Because we subtract it. But in reality, if you understand how interest rates work, it's actually a 200% return, right? Another way to say that is, if you were compounding money at 2% over 10 years, and then you compounded money at 6% over 2 years, the account at 6 would be 200% more than the account at 2.
Okay.
Or if I sold you a hammer for 2 and then you sold it to your friend at 6, did you make a 4% return or a 200% return?